And we're back with another episode of Living in Granbury and Beyond. Today, we're going to look at a new Fed chair coming in. We've got a funny photo from posted by the president regarding this, but May 15th, we're supposed to have a new Fed chair coming in, and we're going to break down what we expect to happen this summer and moving forward. If this is your first time to the channel, we really appreciate you tuning in to today's episode where we kind of give a market projection and changes we expect to happen with the new incoming Fed chair. As always, we get people that are following the channel. Maybe they're looking at lakefront homes. Maybe they're looking at a relocation for work. Maybe they're looking for a weekend home to come hang out here in Granbury. A lot of times people are 6-12 months out before they're going to make a decision, and we have people that reach out to us all the time for advice or just to introduce themselves so that we can get them on our radar. We'd love the chance to chat with you, visit with you, or offer any advice that we can. So just call, text, or email, reach out to us. We'd love to hear from you. So jumping in today, we've been looking forward to a new Fed chair for a year and a half, 2 years. The current Fed chair has been persistent with higher rates than is comfortable for realtors. And there's been signals that we feel like could have been taken to lower rates that just weren't. That said, we also were critical of this particular Fed chair when we were told that inflation was going to be transitory, even though we printed trillions of dollars. All of that combined put a lot of bad taste in people's mouth. So having a new Fed chair has been something that many have been looking forward to. With that, there's also some cautionary things I would like to provide, and we're going to jump into several of those right now. So I'm going to share my screen, and we're going to look at a few pieces of information. So the first piece of information that I wanted to show you is April jobs report just came out, and the economy added 115,000 jobs. I believe the projection was for 65,000. So significantly more jobs added. So the Fed's kind of their war is we want to bring inflation down without bringing job growth down too much. So a lot of times when you bring inflation down, you see jobs market start to contract as well. So they don't want to over contract the job market in their trying to caution or slow down inflation. That has been a big struggle for them for the last 18 months. Right now, we've got inflation that is kind of rearing back its ugly head with the higher oil prices from the conflict in Iran. It's causing some concerns about inflation. What you don't want to see is, as that's happening, to also see jobs contracting, because then what do? You're either going to destroy the job market or you're going to let inflation run rampant. So right now, the main concern is going to be inflation, because the job reports are coming back a little bit better than what we would expect. Last month's jobs report is actually revised upwards by, I think, like 7,000, but the month before that revised down by, I forget how much, but it was like 20 or 30,000 revision downward for February. So with all of that, this jobs report is gonna, I think, add a little bit of texture to our anticipation of what this new Fed chair is gonna do. The fact that inflation is becoming an issue again, and the fact that the jobs are looking pretty strong, I don't see this Fed chair just dropping rates immediately. So that was point one of my cautionary warning about a new Fed chair, and thinking that's going to mean immediate low rates, like right out the gate. All right, so the next article I wanted to jump in with you, forget rate cuts. A veteran broker says new Fed chair Warsh will print money instead. The subtitle is Warsh likely to be confirmed next week, but rate cuts may not follow. He is going to go through some similar things, focusing on the Iran conflict and leading us to probably not anticipate any immediate cuts until after this conflict with Iran subsides and we get a handle on inflation. If oil prices stabilize back close to where they were, that's going to relieve the concerns about inflation, and then it would be mainly a look at the job market and what's going on there for what we're going to do with the mortgage rates. The bond yields are kind of directing traffic in this time, and any sort of news about any rising oil prices or anything like that causes the interest rates to just stay high, and I do not believe that Warsh is going to step in and try to resolve that by lowering the Fed rate unless we get some conflict resolution in Iran. So you can read a few of the things here, pretty interesting stuff. And then we've got another article here. This one, jobs data, mortgage rates, and housing demand. Basically this is a guy that I follow, Logan Motashomi. He is one of my favorite analysts in the real estate space. Basically what he's saying, same thing, until this conflict resolution takes place in Iran, do not expect there to be much progress in terms of mortgage rates. We've seen rates up and down. Whenever they make a peace deal, rates come down. Whenever the peace deals kind of crumble, rates go back up. I think the market wants to go down as far as in rates. We want to go lower on the rates, but we need to get this conflict with Iran settled before we're going to see any long-term stability. This article right here with the Wall Street Journal, April hiring keeps Fed on hold, shifts focus to inflation. This was an article that basically it picks up on several of the key points that we've been focusing on, or that we've been thinking are the key issues. And it says the same thing. We're talking about a Fed that is going to be looking at inflation over the jobs market because of the positive market news in the labor. So if something happens next month and there's a lot of layoffs, that changes the whole game, because that is the number one concern of the Fed is going to be the labor market. Unless we get some bad news out on labor, they're going to be focusing on inflation for the next, I'd say, 30 to 60 days. And so that, even though the new Fed's coming in, probably means we're not going to see much progress in terms of lowering the rate immediately. All right, last but not least, this is to kind of give you a little bit of understanding the momentum. Last year, unemployment hit a pretty high clip. Rates were dropping below 6% for the first time. We were at 12-month lows on interest rates, and we were seeing the most growth in real estate that we had seen for several years happening at the early part of 2026 before the conflict in Iran kicked off. And with this conflict, we've seen rates begin to jump back up. The market began to recool, and we're kind of back to where we've been every year in terms of what we're seeing in the market. It doesn't mean the market's just dropping off. Doesn't mean that prices are crashing. None of that. It's just where everyone's ready in our space to see year-over-year growth, more home sales, and just an overall more balanced and healthy market. Right now, we're not quite there, and until this conflict is resolved, we're not going to see that happen. But I believe that as soon as we get resolution, the market was gearing up to really begin to ramp up and do well. So rates get back down 6% or below over a 3 to 6 month period, you're going to see the market really begin to warm up again. That's the pent up demand is there, and all of these market factors are kind of holding it at bay, but the market really wants to grow right now, but these things keep slowing it down. So with that, I hope you found this information helpful. I have not done many market updates here for the last few weeks, but this one's a big one. The new Fed chair coming in, there's going to be a different orientation with this Fed, and I do believe that we will get quicker responses. So if the conflict gets resolved and oil prices go back down, I think this is the sort of Fed chair that will probably go in and lower rates pretty quickly. But while the conflict is going on, while the inflation concerns are there, and while the labor market is looking pretty strong, I don't think he's going to come right out the gate and just drop the rates. I don't see that being the strategy that he's going to employ. But if we get some resolution, or if we get any negative news in the labor market, that might give him a leg to stand on and actually lower the rates sooner than I would anticipate. So new Fed chairs coming, lower rates are on the horizon. How soon are they coming? Probably not immediate with the stuff that's going on, but I think the future is looking bright. I think we should be optimistic about the housing market moving into the latter part of the summer this year, and I think we will see some things begin to really improve, especially if that conflict with Iran gets sorted out here soon. That would be great news. So anyways, hope you guys are having a great summer. Have any questions, call, text, email. Love to hear from you. If I don't hear from you, hopefully I'll see you around Granbury sometime.